On April 8, 2026, one day after a ceasefire was announced between the U.S., Israel, and Iran, the S&P 500 surged 2.5%. The Nasdaq jumped nearly 3%. The Dow had its best single session in almost a year. Financial media called it a relief rally, markets celebrating peace. The war was over. Time to buy. There was just one problem. The war wasn't over. So why were stocks at all-time highs? To understand what really happened on April 8th, you need to understand what Wall Street looked like in the weeks leading up to it. Because this story doesn't start with a ceasefire announcement. It starts with a crisis. On February 28th, the United States and Israel launched joint airstrikes on Iran. Supreme Leader Ali Khamenei was killed. Within days, Iran retaliated by shutting down the Strait of Hormuz, the narrow choke point through which roughly 20% of the world's oil supply flows every single day. The market's response was immediate and brutal. The S&P 500 fell nearly 9% over 5 weeks. That's its worst losing streak in almost 4 years. And while your 401k was quietly screaming, something else was happening beneath the surface. Wall Street was panicking. Goldman Sachs, which operates one of the largest prime brokerage desks on the planet, giving them a front-row seat to what the biggest hedge funds are actually doing, released data that told a stark story. Hedge fund selling in North America during Q1 was the largest since April 2020. Gross leverage was sitting above 300%, near an all-time high, and short exposure to major macro ETFs like SPY and QQQ hit the highest level since the pandemic. Translation? The smart money wasn't just bearish, they were aggressively betting that stocks would fall further. And the expert voices were even more alarming. On March 19th, commodity analyst Rory Johnston said this, and I'm quoting directly, "Every analyst I speak with, people I respect, people who are not alarmists, people who make fun of the alarmists, they're all terrified. With the strait remaining closed, we still need to shed 15 million barrels per day of global demand. We're talking $250, $300 a barrel of Brent crude. Recession is too light a term. We're talking depressionary." March 19th, 2026. Keep that quote in mind because we're coming back to it. Fast forward to the evening of April 7th. President Trump posts on Truth Social, a ceasefire has been reached. The conflict with Iran is over. When markets opened the next morning, it looked like someone had flipped a switch. Over 400 names in the S&P 500 finished green. 13 stocks printed all-time highs. Brent crude collapsed 13.5% in a single session. WTI crude dropped more than 16%, the biggest one-day decline since April 2020. Financial media was euphoric. Markets celebrate peace, relief rally, the all-clear signal. Except, here's where the mainstream explanation completely falls apart. Maritime intelligence firm Windward, which uses AI to cross-reference live GPS signals with satellite radar and imagery, was tracking vessel traffic through the Strait of Hormuz in real time. Their data? By midday on April 8th, the same day the so-called peace rally was happening, only 5 outbound cargo carriers had been detected moving through the strait. 5. The pre-war baseline was 130 daily transits. That's a 96% drop in traffic. So, let me ask you this. If the ceasefire had actually resolved the crisis, if the Strait of Hormuz was truly open again, why was 96% of normal shipping traffic still absent? The answer is because the ceasefire hadn't resolved anything. The markets weren't rallying because the war was over. They were rallying because of a short squeeze. Let me explain exactly how this works, because once you understand the mechanics, everything about April 8th makes perfect sense. When a hedge fund shorts a stock, here's what actually happens. They borrow shares from a broker, then sell those shares immediately at the current price. They're betting the price will fall. If it does, they buy the shares back cheaper, return them to the broker, and pocket the difference. But if the price goes up instead of down, they're in trouble, because they still have to return those borrowed shares, which means they have to buy them back at a higher price than they sold them at. And here's the dangerous part. If the price keeps rising, their losses keep growing, with no ceiling. At some point, their broker sends a margin call. Either add more cash to your account or close the position right now. When enough short sellers get margin calls at the same time, they all scramble to buy back their shares simultaneously. That buying pressure pushes prices higher, which triggers more margin calls, which triggers more buying. The feedback loop accelerates. That is a short squeeze. And on April 8th, with short exposure at its highest level since 2020, the squeeze began. But the short squeeze was only the first domino to fall.
The second domino, the CTAs, Commodity Trading Advisors. These are systematic trading firms that run on rules-based algorithmic models. They don't read news, they don't analyze geopolitics, they simply follow price trends. When the trend is down, they go short. When the trend is up, they go long. Mechanical, automatic, no human discretion whatsoever. Goldman Sachs reported that CTAs were sitting on roughly $30 billion in net short positions heading into the ceasefire. But the moment the S&P crossed certain price trigger levels, their models didn't move to neutral, they flipped completely, from maximum short to maximum long. Goldman's originally estimated these funds would need to buy approximately $40 billion of equities to cover their positions. The actual number? $86 billion across just 5 trading sessions. According to Goldman's own records, that buying speed ranks in the top 5 of all time. Then came the third domino, the options market. When investors pile into call options, bets that prices will rise, the dealers on the other side of those trades have to hedge their exposure by buying the underlying stock in real time. As prices move higher, they buy more. This mechanic is called dealer gamma hedging, and it can turn a moderate move into an explosive one. Spot Gamma, a leading financial data platform, had flagged a negative gamma environment heading into the ceasefire. In that regime, dealer hedging doesn't stabilize prices, it amplifies them. Price goes up, dealers buy more. Price goes up more, dealers buy more still. 3 distinct forces, all triggered within hours of each other, all pointing in the same direction, buy. That's the April 8th rally. Not peace, not fundamentals, not a changed outlook on the global economy. A mechanical feedback loop, triggered by a headline, but driven entirely by market structure. And here's the thing, this pattern isn't new. We've watched this movie before. December 2018, stocks had been crashing for months on fears of aggressive Fed rate hikes. Then Jerome Powell stepped to a podium and said a single word, patient. The Dow pained over 1,000 points that day, the first time in history it had ever done so in a single session. Not because the economy changed, because sentiment shifted and the machines responded. August 2024, the Bank of Japan hiked rates for the first time in 17 years. The yen carry trade began to unwind. The Nikkei dropped 12% in a single day, then bounced 10% the very next session. Same mechanics, different trigger. Different headlines, same underlying architecture. So why does this keep happening? Why do we keep seeing these massive moves that don't match economic reality?
Because the stock market has fundamentally changed, and most people don't know it yet. 20 years ago, markets were dominated by human beings, portfolio managers reading earnings reports, analysts modeling cash flows, fundamental investors making deliberate decisions about what a business was actually worth. That market is largely gone. Today, 63% of all U.S. stock funds are held by passive index investors. That's more than $13 trillion of capital that doesn't read a single earnings report. It doesn't care whether Apple had a good quarter or whether oil is at $300 a barrel. It simply tracks the index, automatically, on autopilot. And because most passive funds are market cap weighted, the bigger a company gets, the more of it they buy, which is how the Magnificent Seven now accounts for over 33% of the entire S&P 500, a third of the index, concentrated in just 7 companies. What's left of active investing has also changed dramatically. The hedge fund industry has consolidated around a small group of massive multi-strategy platforms, Millennium, Citadel, Point72, operating with 4 to 8 times leverage and strict automated drawdown rules. When they hit their loss limits, they don't deliberate, they sell, immediately, algorithmically. And underneath all of it is the options market. Same-day expiration options now make up roughly 63% of all S&P trading volume. On peak days, over $2 trillion in notional value changes hands in a single session. Every one of those contracts forces a dealer to hedge in real time, buying or selling the underlying stock to keep their book balanced. The dominant players in today's market aren't analyzing valuations, they're reacting. And when price moves, their reactions stack on top of each other, amplifying moves in both directions faster than any human can process. So what do you do with all of this? First, stop trusting the narrative. When financial media explains a market move with a simple headline, ask yourself, is that actually what drove it, or is that just the story that fits the chart? On April 8th, Peace Rally was the story. Short squeeze, CTA flip, and gamma hedging was the reality.
Second, understand that volatility isn't random. The conditions that create these explosions, record short exposure, negative gamma regimes, systematic positioning at extremes, are measurable. Goldman publishes the data. Firms like Spot Gamma publish options exposure in real time. This information exists. You just have to know where to look. Third, and most importantly, recognize the world you're actually investing in. The stock market you grew up hearing about, the one where patient investors find undervalued companies and are rewarded over time, that market still exists for long-term holders, but the day-to-day price action, that's something else entirely. It's a giant interconnected feedback loop of passive capital, leveraged algorithms, and options dealers, all reacting to each other in real time. The headlines are the narrative people use to rationalize what already happened. If you want to understand what's actually driving markets, not the simplified version, not the after-the-fact rationalization, subscribe. This is the content traditional financial media doesn't have time for. The market has changed. Your understanding of it should too.